Hello, and welcome to the Kluge Wealth Advisory Group monthly update video from August 2024. In this month's video, we're going to cover a number of topics, including some back to the basics, tips and traps, a monthly market update, a monthly portfolio update, and of course, last but not least, your frequently asked questions. And as a brief reminder, you can find all of our content online on YouTube or on the X platform. To start off this month's update video, I want to introduce a segment we're calling Back to the Basics. And the purpose of this segment is just to discuss important ideas that can be overlooked from time to time that are really important to review. This month's Back to the Basic idea is compound interest or compound return. Now, compound returns can be understood through the rule of 72. And what that means is that if you take the number 72 and you divide it by a rate of return, that tells you how long it took for the asset to double in value. So if you have a rate of return of 7.2%, you divide 72 by 7.2%, it ends up taking 10 years for the asset to double in return. Alternatively, if you were to earn 10%, it takes 7.2 years for the asset to double in return. Now, compound returns are really, if you think about it, the rate at which the money you made on your money makes you more money. And small differences in return can make a huge difference in outcome. And to really illustrate this, if you earn 7.2% over 20 years on a $1 million portfolio, it would end up being worth $4 million, which is pretty good. However, if you earn 10%, you would actually end up with $6.7 million, which is, well, more than 50% better. This is why Albert Einstein called compound return the eighth wonder of the world. And it's also why we want to make sure that we keep a long-term perspective when investing so that we have the power of compound returns working for you. Moving on to our next segment, we want to discuss a segment we like to call tips and traps. Now, tips are things you want to consider doing, and traps are things you want to avoid. So starting off with this month's tip, and that is to understand the difference between a successor holder and a beneficiary in a tax-free savings account, or TFSA. If you've designated a beneficiary of your TFSA, then that person, when you pass, will receive the value in the TFSA. If you had $100,000 in the TFSA, that person will receive $100,000. Now, if you have them set as a successor holder, then they as successor holders would be allowed to roll that money in your TFSA into their own, so that your $100,000 in TFSA would be merged with their value of their TFSA. This has some significant benefits, as it does allow further tax-free compounding of wealth. And as we just talked about in our Back to the Basics segment, tax-free compounding of wealth is the eighth wonder of the world, at least according to Albert Einstein. Moving on from tips, let's discuss this month's trap. Now, with kids going back to school and students going back to university, the trap we wanted to discuss this month is what happens to leftover balances that are inside of RESPs, or Registered Education Savings Plans, when all the beneficiaries have completed their education. The bottom line is there's not really a good way to deal with that balance. There's a few allowed methods where you can move money out, however, they all have significant disadvantages or limitations. The first one is you are allowed up to $50,000 to roll the balance of an RESP into an RRSP. However, you do need to have that RRSP room available, and before you do the rollover, you have to give back the grants to the government. The second is that you can wind up the RESP. Now, that has some really significant disadvantages because the funds that come out of that wound up RESP are taxed to you as regular income, the grants are returned to the government, and then an additional 20% penalty tax is applied to any proceeds from the RESP. So, where possible, we always want to encourage clients to make sure that those RESPs are exhausted. And of course, if you have any questions on this, please reach out to the team. We're here to help. In terms of an August market update, there's a few key things to note. The first is we saw the first bout of summer volatility. Markets sold off sharply in early August on fears of recession, Iran and Israel tensions, as well as spillover from the volatility in foreign exchange markets related to the Japanese yen. However, as August progressed, markets rebounded and we saw a continuation of the broadening out trade that we noted last month. We saw the S&P 500 outperform the TSX and the TSX outperform the NASDAQ. With interest rates we saw interest rates fall over the course of the month, which led to significant positive performance from fixed income assets. Conversely, we saw commodities generally decline. Even with the increase in the price of oil, the general level of commodities as measured by the Bloomberg Commodity Index was lower. In terms of a portfolio update for the month of August, there are no major changes to report. I would like to note that it is very normal, however, to see seasonal weakness in September and October. And this is a normal phenomenon and especially true in US election years. Now, this usual weakness that we see in September and October is as normal as a very powerful rally is in November and December. And I would like you to think back to last year. September and October weren't very great months. However, November and December more than made up for all that lost ground. The other thing I wanted to note is that we're coming to a time where there's a bit of a dichotomy emerging in the market. We're in the longer term, when you have falling interest rates, falling inflation, and slowing but not recessionary growth, typically you see secular growth names outperform. The easiest way for me to put this is that NASDAQ outperforms S&P 500, S&P 500 outperforms TSX. However, in the initial stages of rate cuts, you can see a phenomenon where stocks that have underperformed to date begin to play a bit of a catch-up. Now, this broadening out trade is very healthy, and it's something that we have some exposure to where we can get that exposure in a high-quality fashion, which is why you'll see 2 ETFs that we added in the month of July that cover value sectors, which are typically more financially and industrial-based. Of course, if you have any questions on this, I'm happy to go into more detail and provide you some more rationale. And please reach out and give us a call. We are here to discuss and to help. In our final segment, we're going to discuss some of the frequently asked questions that we encountered in our client conversations over the course of August. The first question I often get is, early August was a bit volatile. What happened? Well, very simply put, we had a combination of things happen. The first is that you had some bad economic data that triggered recession fears. The second is that you had increased tensions between Israel and Iran. And the third is that you had the Japanese central bank raise interest rates, which caused volatility in the foreign exchange markets related to the Japanese yen. Now, this explanation usually leads to another question, which is, how on earth does the value of the Japanese yen impact the value of stocks in the United States? Well, to understand that, there's a very simple thought process here. In Japan, interest rates are effectively zero. So if you borrow in yen and you turn those yen into US dollars, you can earn return through equities or fixed income by investing in the United States. However, if the Japanese yen goes up in value, you can end up in a situation where you have to pay back the loans you've taken. And that's exactly what happened. The Bank of Japan unexpectedly raised interest rates, and this caused investors in Japan who had borrowed in yen to buy US dollar securities to have to start to repay those loans. And part of the problem was that many of those Japanese investors were using an enormous amount of leverage or borrowed money in order to make their bets look better. So an increase in the value of the yen caused them to have to sell assets in the US in order to pay back the loans at home. Now, disruptions like this do happen from time to time, and they're not unheard of. And as we can see through the month of August, the markets rebounded. And so disruptions related to items like this are very often temporary because the drivers are very temporary. Now, this question would often be accompanied by another question, which is really, has something changed, or has the market put in some sort of a significant top? We always want to bear in mind that history or pattern is not predictive. But if we think of times when you've seen moderate economic growth that's still positive, falling inflation and falling rates, historically this has been very positive for equity markets. And we also need to think about this from a psychological perspective. Usually when bull markets end, investors are euphoric and can only see upside and often ignore bad news despite it being very present. And I would suggest that's the exact opposite conditions that we saw here in August, which to me says that there are many investors in the market who are owning equities reluctantly and that they are not fully invested. And this would jive with the fact that a single data point was able to change the narrative from we're okay to we are in a recession now, and the fact that there's $6.2 trillion sitting in cash. In my humble opinion, I do believe that a lot of investors are reluctantly invested in equity, and as such are really, really twitchy. And so the slightest thing to go wrong means that they're going to head for the exits. This also means historically that this run isn't over, and the market has not put in a significant top, despite any short-term volatility we see now or through the fall. I'm always reminded of the John Templeton saying, when he quipped that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And I'm going to suggest that the market correction in August suggests that we are nowhere near euphoria, and we're somewhere still in skepticism. The final question that we encountered on a regular basis over the course of the month related to the US election and the potential impacts. Now, there's a lot of unknowns here. We don't have a really substantial policy package from either candidate, whether that be Kamala Harris or Donald Trump. The second thing I want to note, though, on a positive note, is that historically the markets haven't cared who wins, whether that's Democrat or Republican. Once uncertainty around who the victor is going to be is removed, then markets tend to rally and rally very powerfully into the end of the year. And this would also jive with some other data that's out there that's important. And that finds that, since 1980, if the S&P 500 is up more than 10% into June 30th, that the last 6 months of the year, that being July 1st to December 31st, also produce a 10% return. And that would indicate that despite whatever volatility we may see through September and October, that there's a really good chance that November, December are going to be really good. And as we finish off answering this question, I did want to note that there is a lot of anxiety around this election, and that there's a lot of expectations for some sort of significant correction. And I also want, although I would believe that it could happen, I also want to keep my mind open to the fact is that if everyone's anticipating something, sometimes that's exactly what doesn't happen. And that there are several credible technical systems based on time series that would actually predict no volatility for September or October, and then a small early November correction before a large rally into year end. Thank you for joining me for the Kluge Wealth Advisory Group August Client Monthly Update video. In this video, we covered off some topics related to back to the basics, tips and traps, a monthly market update, a monthly portfolio update, as well as discussing frequently asked questions that we encountered. Just as a reminder, you can find this video and all of our content on the X platform or on YouTube or on our team website. And of course, if you have any questions or is there anything that you need from the team or I, please pick up the phone. We are here to help and get the job done.